If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Finance Friday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What is going on, everyone? Happy Friday. Welcome back to another Finance Friday episode, where every Friday we dig into tips, strategies, tricks to get your money working hard for you. Because after all, we know it's not what you make, but what you keep. And today, the strategy I want to talk about has to do with the 1031 exchange. And before I get into that, everyone knows the fee. I don't have any ads on the show. The only way we can get this to more people is by you, the good people, sharing the show. So if you got any value from this, please share with a friend, family, colleague, maybe just an acquaintance that you think could get value from the show. Please share with them, share it on your social. If you haven't done so, please leave a rating review, because that's how the good old Apple algorithm gets the show to more ears. All right. So let's talk about 1031 exchanges. And for those that aren't familiar with the 1031 like-kind exchange, what it is something you can use in real estate and, in fact, most types of assets where you sell it and you have a gain, right? And we know when you have a gain that's not in a qualified plan, you're going to have tax on that capital gain. And what's great with 1031, specifically in real estate, what you can do is if you sell that property, then you can 1031 into another like-kind property. So for instance, what we do is if we had an apartment building, we sold it, we would 1031 into the next apartment building we want to invest in. And there's a timeline you have to follow by. You have 45 days to identify or nominate that next acquisition from when you sold. And then you have a total of 180 days to then close. So it's a total of 180, not 45 plus 180, 180 days. And when you do that, you are deferring those capital gains taxes. So essentially, you could keep doing this and keep 1031ing all your properties, and say you end up with a $100 million portfolio. When you die, right? So there is that basis, that original property, say it was a $500,000 property. There is that basis that just kept getting deferred and deferred and deferred. So you have a bunch of capital gains. So then when you die and it goes to, say, your children, say your beneficiaries, they get something called a step up in basis, where their new basis is the fair market value on the day you died. So say it was 100 million. Now their basis is 100 million, and they could then go sell it immediately. And if they sold it for 100 million, there would essentially be no tax, right? Because there would be no gain based on their basis. So that's a really powerful strategy. However, if you just kept deferring, and then you decided to sell before, obviously before you passed away, you just wanted the cash. So then maybe you could either do something else with it, or then that's how you were going to give away inheritance to your beneficiary. There would be then a tax consequence, right? Because that deferred capital gain, as long as the tax code stayed the same, obviously, that would be then, you would realize that. So that's why it's probably best, you hear people buy and hold, right? That's one of the reasons. However, I want to talk about, another method instead of using the 1031. And I also want to preface this that I'm not a tax advisor. So everyone's situation is different. And what I'm about to say does not necessarily mean that it would be in your best interest. So please do check with a tax professional, your tax advisor, your CPA, whoever it happens to be. But there are circumstances where it may not be the best move for you. There's a whole thing of velocity of money. You got debt equity. You should probably sell the property, because if you do the calculation, you could be potentially making 1% a year with the cash flow you're generating compared to the debt equity that's in the asset, right? You've made so much equity that return on that equity is so small, because your cash flow hasn't gone up, equally. So it might be smart to sell. And then you think, okay, that's fine, but then just 1031, Shawn, why not just 1031? And yeah, maybe that is the best thing for you to do. But also there could be a circumstance where one, this is the best time for you to sell, but you're unable to identify the next property. But right now is based on market conditions. Just think, maybe this was back in February. You're hearing like rates may go up. It's still a hot, frothy market. This would be the best time to sell. So sell, right? But you're thinking like, I probably won't be able to find something because by the time it closes, the landscape's going to change. There might not be the opportunities. So that could happen. One, clearly, right? You wouldn't be able to find it, but it is the best time to sell. Two, you really need depreciation for maybe something else that's going on in your life to offset some gain. But what happens when you do a 1031, you're limited in that depreciation capture because you have an increased basis, your basis is lower, right? So this limits the amount of depreciation one can claim, which obviously is one of the biggest incentives. So what a strategy could be, again, it's not for everyone, but what a strategy can be is an alternative 1031 is simply just sell the property. And then once you identify the next one, obviously within, be smart to do it within that tax year, you now have an increased basis when you acquire that new property, right? Because you're taking that gain and you're purchasing a new property. So now you have that basis, and which then will yield a larger depreciation deduction. You do obviously do this. We've talked about this before, cost segregation analysis, where you hire a company to come in, engineers that look at the life expectancy per item of the building. So it could be anywhere from the roofs, the plumbing, the furniture, the flooring, the windows, appliances, so on and so forth. Everything has a different lifespan, which then can be deducted at a potentially accelerated rate because it could, for instance, have a shorter lifespan. Again, something you would want to check with your tax advisor. So with that larger deduction now, because you're able to get the larger depreciation because you didn't do the 1031 and now you have the larger basis, excess losses transfer over and offset any capital gain or depreciation recapture that was owed on the previous property. Now, again, it won't always work perfectly. That's why you want to check with a tax advisor, but it is a strategy where you still can then offset that gain and then have potential depreciation to offset income, right? So I just wanted to get on here, just have a quick one. And the reason for this is I had a conversation recently with someone who wanted to sell property, but they wanted a 1031. And they ended up not selling the property back in January timeframe. It was actually initial conversations were December, but probably would have closed in January, February. Would have gotten a really good number back then. Not that they can't get a good number now, but it's significantly less. Didn't do it because they realized they just couldn't identify the next property. Well, if they had done that and sold, yes, they probably wouldn't have been able to identify something within 180 days. But now there's opportunities that are starting to arise. We know what the market's doing. Opportunities are coming up. You can get at a really good price. This individual could have sold and just sat on that cash for the next, 6 months and then acquired something. And then it would have, had that basis, which then would have resulted in a great cost segregation analysis yielding depreciation that could have then offset the gain. And now that didn't happen. They're not going to be able to sell for as less, meaning they're not going to be able to buy as big of a property. And there's many reasons that should have happened. But I just want to get on here, share this. It is a great strategy. Obviously, as I've said, check with the tax professional, your tax advisor, your CPA to see if that would be the best for your situation. But I just wanted to share an alternative way to offset capital gain without having to do the 1031. And then, as I've mentioned before, sometimes it's just good to take a little cash out, right? You simply could sell the property. So if you 1031, you have to 1031 all your gains, right? In order for this to work. But what if you sold it, say you made $500,000 Well, what if you took 100K out to then invest in your business, maybe to hire someone new, new marketing, just to invest in your business, right? Like, which you have to do. You want to keep investing in your business to grow and to scale. Then you could take that remainder, that 400,000, and then invest into a property, get that depreciation, offset the gain. Kumbaya. 1031 is not the one and only thing, right? That's not the end all be all. Yes, it's an amazing thing, and I hope it never goes away. It's a great way to grow your wealth and keep investing back into your community, into more real estate. But it's not the end all be all. All right, everybody. Thank you for tuning in. As you know, every Friday, I'm in here to share some tips and tricks. Get your money working hard for you, because we all know easy doesn't pay well, and instant gratification is self-destructive. So get out there, not only work hard for your money, but have your money work hard for you, so you can create the life of your dreams for yourself, for your family, so we can all get out there and be better people in general, and make the world a better place. All right, everybody. Thanks for tuning in, and I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.